Good morning and welcome to the Morning Bell. I'm Robert, joined by Lizzie and Steve. It's Friday, May the 8th, 2026, and we're heading into a jobs report day with markets showing some optimism, but plenty of underlying concerns. Lizzie, what are the main themes you're seeing in today's news?
Thanks, Robert. The dominant theme this morning is really a tale of two markets. We've got Dow futures climbing as investors position ahead of the April jobs report, but underneath that surface optimism, there's significant stress building. The geopolitical situation is heating up with Trump threatening the EU with much higher tariffs if no trade deal is signed by the new deadline. And we're seeing Iran-US tensions involving clashes in the Hormuz Strait, even as Trump claims the ceasefire holds. What's particularly concerning is how these tensions are manifesting in emerging markets. Indian assets are getting hammered as an energy shock sends the rupee sliding, with investors dumping positions aggressively. On the corporate front, we're seeing very mixed signals. Intesa Sanpaolo beat profit expectations thanks to a surge in trading revenue, which shows financial institutions are benefiting from volatility, but Toyota missed fourth quarter profit targets by a wide margin, with a 49% profit slump driven entirely by US tariffs. That Toyota miss is significant because it's a concrete example of how trade policy is hitting major multinationals directly in their earnings.
That Toyota number is striking. A 49% profit slump really underscores the tariff impact. What does this mean for traders and investors positioning right now?
The key takeaway is selectivity and defensive positioning. We're seeing analyst activity pick up with some notable moves. BofA raised Axcelis Technologies to a 130 price target on Memory Outlook, which is interesting given Nintendo just announced they're hiking Switch 2 prices and expecting console sales to decline specifically because of memory supply constraints. That tells you the semiconductor equipment space still has pricing power. On the flip side, Morgan Stanley cut HubSpot on AI transition headwinds, which reflects growing concerns that not every tech company will successfully navigate the AI shift. The broader message from the market is that we're in an environment where trade policy, geopolitical risk, and sector-specific execution are creating massive performance divergence. You can't just buy the index and hope for the best. The Wall Street Journal ran a piece asking if it's looking an awful lot like the tech bubble. And while I don't think we're there yet, that kind of headline tells you sentiment is fragile. Treasury gains ahead of payrolls with expectations for jobs growth suggest the bond market is pricing in a Goldilocks scenario. But if that jobs number disappoints or comes in too hot, we could see rapid repositioning.
Let's talk technicals then. How are you reading the major indices from a technical perspective?
The S&P 100 is in an interesting spot. We're at all-time highs, and MarketWatch actually published analysis saying stocks at all-time highs can still go higher, which is technically true, but also the kind of headline you see near tops. From a pure technical standpoint, the S&P 100 is showing some divergence, with breadth not confirming the price action. We need to see participation broaden beyond the mega-cap tech names. Support comes in around the 50-day moving average, and as long as we hold above that, the trend remains intact. For the Nasdaq, we're seeing similar dynamics but with more vulnerability. The concentration risk is extreme, and with Morgan Stanley cutting names like HubSpot, you're seeing cracks in the growth story. The Nasdaq needs to hold the recent consolidation range, and a break below that on heavy volume would be concerning. The Dow is actually showing relative strength this morning with futures climbing, and that makes sense given it's less tech-heavy and more exposed to value names that benefit from the economic data holding up. The Dow's technical picture is cleaner with a steady uptrend and better risk-reward for swing traders. Overall, I'd say we're in a show-me market, where the jobs data today will determine whether we get continuation or correction.
That selectivity is going to be key. Steve, let's get into the economic numbers. What's the picture looking like heading into this jobs report?
Thanks, Robert. Today's April jobs report is the centerpiece of the week, and it's coming at a critical time for monetary policy and market positioning. The consensus expectation is for solid jobs growth, which is why we're seeing Treasury gains ahead of the release as investors position for a number that shows the labor market remains healthy but not overheating. The challenge with this report is that we're trying to thread a needle here. We need to see enough strength to confirm the economy isn't rolling over, but not so much strength that it reignites inflation concerns and pushes out any potential rate cut expectations. The context matters significantly because we've had mixed signals from other recent data. Bank of America put out research noting that spending in the US just slumped and they're not sure why, which creates this disconnect between what the jobs market might show and what consumer behavior is indicating. If we get a strong jobs number but spending continues to weaken, that suggests households are becoming more cautious despite employment stability, which has implications for corporate earnings going forward. The international data is also providing important context. Japan's March wage growth came in supportive of a potential June rate increase from the Bank of Japan, which matters for global capital flows and currency markets. When Japan raises rates, it typically strengthens the yen and can trigger unwinding of carry trades, which has knock-on effects for risk assets globally. The other piece that's relevant is the World Food Prices Report from the UN, showing prices rising for the third straight month, which feeds into the inflation picture and could influence how the Fed interprets today's jobs data in the context of their dual mandate.
So we're really looking for that Goldilocks number. Lizzie, let's shift to crypto. What are the trends you're seeing in digital assets heading into next week?
Bitcoin is at a critical juncture right now, and I'd characterise the sentiment as cautious bearish heading into next week. BTC slipped below the $80,000 level, which is a significant psychological barrier, and that triggered about $300 million in futures liquidations. What's particularly notable is that Bitcoin ETFs just snapped a 5-day inflow streak and recorded their first May outflows, which suggests some profit-taking after the recent rally. However, the underlying fundamentals present a more nuanced picture. Bitcoin exchange reserves fell to a 2-year low after an $8 billion exodus from exchanges, which typically indicates long-term holders are accumulating and taking coins into cold storage. At the same time, we're seeing negative funding rates hit 10-year records, which sounds bearish but is actually a contrarian bullish signal, because it means shorts are paying longs and the market is overly pessimistic. The key levels to watch next week are 76,000 on the downside, which Tom Lee identified as critical support that would confirm the bull market if Bitcoin ends May above that level, and 80,000 on the upside, which needs to be reclaimed for continuation toward the $115,000 target some analysts are calling for by December. Fund managers are doubling down on Bitcoin positions according to CoinShares data. So you've got this interesting dynamic where institutions are accumulating, while retail appears to be capitulating based on the negative funding rates.
What about Ethereum and Solana? How are they positioned?
Ethereum is in more of a neutral holding pattern with sentiment mixed. The big news was Arbitrum Governance approving a $71 million ETH release from the kelp exploit situation, despite US seizure concerns, which shows the ecosystem governance is functioning but also highlights ongoing regulatory uncertainty. Bitmine announced they're slowing down Ether purchases as they near their accumulation goal, which removes some buying pressure from the market. There were also technical concerns with Vitalik Buterin getting targeted by sandwich bots during a swap, which highlights the MEV issues that still plague Ethereum despite all the scaling improvements. For next week, I'd expect Ethereum to largely follow Bitcoin's direction, given the lack of ETH-specific catalysts. It's in a neutral stance and will likely move in correlation with BTC. Solana is even more dependent on broader market sentiment, with very limited Sol-specific news in the cycle. The one development was Solve ditching Layer 0 for Chainlink to protect tokenized Bitcoin, which shows ongoing infrastructure improvements in the ecosystem, but doesn't provide immediate price catalysts. Solana tends to act as a higher beta play on crypto sentiment, so if Bitcoin breaks down below $76,000, expect Sol to amplify that move to the downside. If BTC reclaims 80,000 and pushes higher, Solana would likely outperform on the upside. The overall crypto strategy heading into next week should be cautious with tight risk management, waiting for Bitcoin to reclaim 80,000 before adding aggressive long positions, and watching those ETF flow reports for confirmation of trend direction.
Well, Ben, we start the sell. That gives us plenty to watch as we head into the weekend and position for next week. The jobs report today will set the tone, and in crypto, we're watching those critical support and resistance levels on Bitcoin. Thanks to Lizzie and Steve for breaking it all down. Remember, do your own research and consult with financial advisors before making investment decisions. If you found today's discussion valuable, please subscribe to the Morning Bell so you never miss our daily market analysis. We'll be back Monday morning with fresh insights. Have a great weekend, everyone.